Hi, I'm Chan Zihang from UW program, and today I would like to present our group report, which is in the subject FIN 322 Advanced Corporate Finance, with my group members who is Lim Jie Hui, Jasmine Ong Suing, and also Yash Ali Akram. So in this case, NPV method is used. It is simply because it takes into account time value of money, cost of capital, and any inherent risk in making projections on future. Besides that, it provides an insight on whether an investment will create value for a firm or not, accompanied by how much is the value in terms of dollar. If the NPV is positive, it will increase the firm value by the particular amount, and therefore one should accept the project. If the NPV is negative, reject the project as it will decrease the firm value by that amount. So the firm will lose nothing through the rejection of negative NPV project. So for the first part, which is the capital budgeting, as you can see, there is the total cash outflow at the beginning of project in the figure 1.1, which is 30,460,000. So for the vessel purchase, the Energy Fuel Proprietary Limited invests in a new project by purchasing 8 new vessels with each cost $4 million. It is a cash outflow, thereby indicates negative $32 million. So for the working capital adjustment, net working capital is calculated by deducting current liability from current asset. By taking the project, the firm has to spend $1 million on holding heavy diesel inventory. The firm also needs to purchase additional $150,000 of light diesel in effort to increase its inventory level up to $500,000. The petrol is no longer required in the project, and hence original $50,000 of petrol inventory on hand can be sold off. Shortly, the firm's working capital will be negative $1,100,000. Next is the proceeds from sales of all barges. As stated in case study, the firm has to sell all existing barges to take on new project. Those barges refers to 4 barges bought 5 years ago and 4 renovated barges. The former cost $2 million each and sum up $8 million, whereas the later cost $400,000 each and sum up $1,600,000. Total contributes to $9,600,000. All barges can be sold today for 20% of original cost. Therefore, proceeds from sales will be $1,920,000. For the tax benefit from proceeds from sales of all barges, comparison between book value and market value of assets is needed to determine the capital gain or loss after asset sales has incurred to categorize whether it is tax benefit or loss. The book value can obtain by deducting accumulated depreciation from cost. As mentioned, cost of 8 barges sum up to $9,600,000. Total accumulated depreciation from barges is $5 million, in which accumulated depreciation of 4 barges purchased 5 years ago is $4 million, whereas 4 renovated barges is $1 million. Hence, the book value here is $4,600,000. Moreover, the market value of barges are lower than the book value. A capital loss of $2,680,000 has incurred. It creates tax saving for Energy Fuel, which amount up to $804,000 and provided 30% tax rate. So for the retrenchment, since not so many staff are needed after acquiring the project, the employees will be retrenched and the firm need to pay them $120,000, which is 50% of their yearly salary. It is a cash outflow, thereby indicates negative $120,000. So for the tax benefit of retrenchment, as Energy Fuel pays out $120,000 to workers, there is a tax effect accompanied. Tax benefit of retrenchment is $36,000 provided 30% tax rate. So for the total cash outflows at the beginning of the project, which is equal to the negative $30,460,000. So as you can see in the figure 1.2, it is the cash outflow over the life of the project in year 1 until year 10. Next, we'll be discussing the revenue from light and heavy diesel. Energy Fuel demand for 5 million liters of light diesel and 10 million liters of heavy diesel annually. Provided margin on sales of fuel is $2 per liter. So for the revenue from light diesel is $10 million, while revenue from heavy diesel is $20 million. Therefore, the revenue from both sources is $30 million annually. Next, the cost of report of $25,000 is excluded because the amount has been spent or committed to spend. thereby is a sunk cost and irrelevant in incremental cash flow calculation. The next part is the opportunity cost of sales of the petrol. The opportunity cost refers to the profit loss when the alternative is selected over another and hence, a particular amount of revenue which will occur in the future result from the activity is foregone after going ahead with chosen option. Moreover, the firm owns total 8 barges which is 4 been purchased and 4 been renovated. Each of them has been acquired 5 years ago. The purchased one has 10 years useful lives while the renovated one has 8 years useful lives. As such, in terms of their usage, the purchased one will be terminated in year 5 and the renovated one will be terminated in year 3. Previously, all barges are capable in supplying 2 million litres of petrol and 4 million litres of light diesel annually, provided margin on sales of fuel is $2 per litre. However, Energy Fuel sacrifice on earning revenue from petrol, which is $4 million in year 1 until year 3 and $2 million in year 4 and year 5. In context of light diesel, the sacrifice amount is $8 million in year 1 until year 3 and $4 million is in year 4 and year 5. In year 4 and year 5, amount of petrol and light diesel are cut half because 4 renovated barges have reached the end of useful lives and are no longer functioning. So left merely 4 purchased barges continue to work in year 4 and year 5. After year 5, all barges cannot be utilized. Furthermore, for the safe insurance part, the petrol is no longer distributed, hence the firm insurance premium will drop by $2,000 commencing from first year of operation. The firm is saving $2,000 annually. And also for the safe wages part, there is no much workforce needed. Hence, the firm cut off workers' salary paid by $240,000 commencing from first years of operation. The firm is saving $240,000 annually. For the depreciations of renovate and new barges part, it's stated that new barges purchased 5 years ago has depreciation of 10% per annum for 10 years. Hence, we get the annual depreciation amount of $800,000 for all new barges. This indicates that as depreciation begins after the year of purchase, at year 5, they will be fully depreciated. 4 renovated barges which have the useful life of 8 years are depreciated in a straight line basis. The annual depreciation amount obtained will be $200,000 for all renovated barges. They will be fully depreciated at year 3. Thus, for year 1 to year 3, total depreciation will be $1 million, whereas for year 4 and year 5, it only consists of depreciation of new barges which is $800,000. For the salvage value of renovated and new barges, the salvage value of 4 renovated barges is $50,000 each, which means at year 3 after their 8 years useful life, the total value will be $200,000. At year 5, 4 new barges purchased is worth the salvage value of $100,000 each for their 10 years useful life. The amount obtained is $400,000. Next is the depreciation of new vessel. In this context, acquisitions of 8 new vessels cost $32 million. Using the tax depreciation rate of 10 years depreciation in a straight line basis, the annual depreciation expense will be $3,200,000, which is incurred from year 1 to year 10. As you can see, there is $4,460,000 total cash inflow at the end of the project that's shown in the figure 1.4. For the salvage value of vessel, at year 10, 8 vessels will have a salvage value of 50% of its purchase price each. Thus, the value is $4,800,000. Next is the tax incurred for salvage value of vessel. Company tax rate is 30%. Thus, we need to calculate the tax incurred at the salvage value of 8 new vessels, which is $4,800,000. Energy Fuel has an obligation to pay $1,440,000. So for the recover working capital, the released working capital is recovered from initial cash flow of net working capital adjustment, which is $1,100,000. So the total cash flow at the end of the project, which is $4,460,000. As you can see, there is a total NPV of $86,376,703 in the figure 1.5. For the interest expense exclude, note that interest expense of borrowing $32 million from Citibank at 7.5% interest rate will not be included, given that it is financial cost and irrelevant to incremental cash flow. Next one will be required real rate of return. Nominal rate of return is 11.5%. However, as all the cash flow are presented in real terms using the Fisher equation, the appropriate required real rate of return adjusted for inflation of 2.5% will be 8.78%. The last one is the NPV decision and reasoning. NPV of this subject is worth 86,376,703, which is greater than 0. Given its positive figure, Energy Fuels should accept the project of acquiring 8 new vessels as it will increase the firm's value.
Now I will present the sensitivity analysis. Sensitivity analysis is an invaluable tool used in financial modeling to help analysts consider a broader range of scenarios. Usually the way it is done is that we will isolate one variable and change its value. Then we monitor the corresponding changes to the NPV. Once we know the difference, we can find the unit sensitivity of the NPV to the variable, meaning that once we know how the NPV reacts to a 1 degree change in the variable, we can give the variable any value to find the changes to the NPV. It is also known as what-if analysis. By giving analysts a tool to ask themselves and investors about what could happen if certain variables were to change, it will give them a better understanding of the risks and returns a particular investment might hold. The first variable we will consider is the demand for diesel. We assumed an increase of 20% for the total demand of diesel. That means that 5 million liters of light diesel increased to 6 million liters and 10 million liters of heavy diesel increased to 12 million liters. Once we increase the demand, we can see that the NPV also increased to $113,596,266. We can see from the table given that the NPV increased by $27,216,563, and if we divide that by the 3 million additional liters from the demand, we can find the unit sensitivity, which is $9.07. This means that for every liter of demand, the NPV increases by $9.07. And now that we know the unit sensitivity, we can assign any value to the demand. What if demand only increased by 500,000 liters? Then we can multiply 500,000 liters by the $9.07 to know that the NPV will increase to $90,912,797. Next, the next variable we'll consider is the margin on sales of fuel. We assumed an increase of 20% for the sales margin. This means that the margin on sales increased from $2 to $2.4 per liter. Once we increase the sales margin, we can see that the NPV also increased to $113,593,266. We can see from the table given that the NPV increased by $27,216,563. And if we divide that by the $0.4 of additional margin, we can find that the unit sensitivity is $68,041,408. This means that for every $1 of margin, the NPV increased by $68 million. And now that we know the unit sensitivity, we can assign any value to the sales margin. What if the margin decreased by 20 cents? In this scenario, we multiply the negative $0.2 by $68,041,408 to find the NPV will decrease to $72,768,421. And the third variable we considered is the salvage value of the barges. We also assumed an increase of 20% for the salvage value. This means that the salvage value increased to 35% of the value of the barges. Previously, the salvage value stood at $4.8 million, and with the increase, it is now $11.2 million, which is the 35% of the total value. Once we increase the salvage value, we can see that the NPV increased to $88,307,640. We can see from the table given that the NPV increased by $1,930,937. And if we divide that by the $6.4 million of additional salvage value, we can find that the unit sensitivity is 30.17%. This means that for every $1 increase of salvage value, the NPV increases by $0.3017. And now that we know the unit sensitivity, we can assign any value to the salvage value. And we can ask a what if question: what if the salvage value increased by $5 million instead? In this scenario, we just multiply the we multiply the $5 million by 30.7% to find that the NPV will increase to $87 million. That is the end of our presentation. Thank you.